Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's 8:05 Eastern Time. I'm in sunny South Florida and apologize for the poor lighting on this video this week. It's only 1 week. We'll be back in Colorado next Sunday, and we'll record from our home studio next Monday. Our note this week was titled Defiance. We spent most of the report talking about the regional revolt, that is the pushback from regional Fed presidents against another rate cut in December. Went on to discuss what that implied for our call for a cyclical bull, but secular bear, one more push in the Treasury market to a new low yield, or back towards the low yields of April, 3 3/4 or so, before next year the bond market struggles a bit more. We then talked a bit more about the tech sector, the AI, financing of AI infrastructure, and of course we get NVIDIA's earnings this week. Talked a little bit about the L-shaped Chinese economy, the idea we have a K-shape in the US, but more like an L-shape in China, or even an I-shape, and then wrapped it up with some final thoughts. So this is likely to be Chair Powell's, effectively his last meeting in December. We expect the new Fed chair to be at the table in January. Ironically, the pushback from these regional Fed presidents risks more inflationary consumption-related stimulus. If we don't get a rebound in the housing market, we don't reopen that bank credit channel, steepen out the yield curve, then the probability of President Trump and the Republican-controlled House and Senate sending $2,000 checks that would be very similar to what happened in 2021 under Biden increases. So this is sort of really twisted policy, in our view, from these regional Fed vice presidents. They failed to read the room all year. There was a San Francisco Fed researcher report that made the rounds this weekend. I don't think everyone got the story around this correct. Some used it, some Trump supporters used it as a reason to, be favorably disposed towards his policies. I'm not sure that's really what the report said, but it was titled, "What is a Tariff Shock? Insights from 150 Years of Tariff Policy." And it concluded that it puts pressure, tariffs put pressure on the economy, reduce employment, and that in turn reduces inflation. I would presume that's the causation. That's certainly the way it's happening this go around, and what the markets imply around all that. This is just misguided policy from our perspective. Quite frankly, the Powell Fed has been an impediment to the manufacturing resistance, or renaissance, during the entire Powell Fed. I mean, shortly after Powell became Fed chair, the Tax Cuts and Jobs Act was passed, and the Fed immediately embarked on a tightening cycle when, in fact, that tax policy was not stimulus per se. It was an expansion of the supply side of the economy that was more likely to create disinflation than inflation. So the Powell Fed has kind of got this wrong all along. We can't get a new Fed chair quick enough who's willing to restructure the staff, and we need a bunch of different voices around the table at those FOMC meetings. Moving on, we would note that by Friday morning, when the S&Ps were down some 70 handles or so, and if you looked at the bond market at that point, the only part of the bond market that had really reacted to all that hawkish Fed speak last week was the very front end of the Fed funds curve. So the market was, in essence, telling Fed FOMC participants that their policy was more likely to weaken the economy and reduce inflation because you drove the economy off a cliff than anything else. If you thought this was just about delaying the Fed rate cuts that would ultimately be inflationary, the market didn't agree with you, because you had lower bond yields from 2s all the way out to 10s split evenly between lower implied inflation, or inflation break-evens, and real rates. And so this really is about the Fed driving the labor market potentially off a cliff here. And ultimately, we think they will end up cutting, and we will get to a point where next year's dynamics are different than this, but where we start to struggle with supply. And as I'm recording this, I'm seeing a Bloomberg headline that says Amazon kicks off 6-part U.S. high-grade bond sale. So there's yet another example of additional supply. So we had a detailed or reasonably detailed discussion about all the controversy around Sam Altman, and we're not the biggest fan of Sam Altman, but we do still think that this trend has some ways to go. And would note, with the pickup in IG credit supply, which through the first couple of weeks of November was almost as big as it was through the entire week of October, we still haven't seen any significant spread widening yet. We think that will come, but more come in the first quarter of next year. And by the way, on the concerns around private credit, we did see a very curious transaction announced by Blue Owl, one of the big private credit issuers, where they're going to merge with a closed-end fund and make the private fund a closed-end fund as well. That's sort of curious actions if we understand what they're doing correctly. But anyway, we do get NVIDIA's reports this week, and net revisions are going, are moving lower. Now, that could just be a mean reversion type of phenomenon, but it is still probably too early to think that the CapEx trend is starting to peak. It will likely be much bigger total CapEx, that is, next year than it was this year. So we wrapped up the note with some thoughts about the Chinese economy, about foreign exchange being integral to negotiations around trade and retailer earnings. To get all those details and our specific recommendations, please become a full paid subscriber to Ironsides Macro. Have a good week, everyone. Thank you.